I currently have 25 holdings in my portfolio, with the largest being cash held in treasury bills. I own 19 large cap stocks, 3 small cap stocks, and 2 ETFs. A very frequent question I get is, which stocks are the largest positions in my portfolio? So let's go take a look and analyze them right now. Now remember, don't buy any stocks that I own or anyone on the internet that they own. We're here to teach a process, and through my holdings, you will see an understanding of my process and I'll be able to explain it better. Stock number 1, Alibaba. This has been a longer term hold for me. It has gotten very popular in the value investing community. It currently makes up 2.9% of my portfolio. My cost basis is a shade under $100 per share. And here is what I like about Alibaba. Alibaba is one of the most dynamic companies in the world. Its cloud computing arm, Alibaba Cloud, ranks as the 4th largest globally, trailing only AWS, Microsoft, and Google Cloud. Baba holds 39% of China's cloud market share, proving its dominance in one of the most competitive tech ecosystem. Then there's obviously the shopping aspect. There's Singles Day, the shopping extravaganza that Alibaba has turned into a global sensation. In 2023, that event alone pulled in $84.5 billion in sales and saw 200 million packages delivered, crushing Black Friday and Cyber Monday combined. On the financial side, Alibaba has been a great cannibalizer of the company. What that means is they're repurchasing their cheap shares. They repurchased 52 million shares in the last quarter for $4.1 billion at an average price of $78.84, signaling confidence in its undervalued stock. Guys, when a company is buying back shares at a cheap price, they are helping shareholders. And it's not just the company buying in. Legendary investors like Michael Burry, Howard Marks have significantly increased their stakes, with Burry adding 29% and Marks boosting his position by a whopping 83% recently. As the price has fallen, the juggernaut that's Alibaba continues to grow and attracting big money and making big moves from these investors. So with Alibaba, let's go take a look at this. Again, you see this chart. A high of nearly $320 back in October of 2020. Over 4 years ago, it hit $320 per share. Now, one thing I want you guys to know is all the negative stories today about Alibaba and China, guess what? They were issues back here. The only difference is they became an issue when the stock goes like this. ADR shares, not owning the actual company. That was an issue back here. China communism. Are you telling me China was less communist back here than they are right here? Taiwan. Guys, it might not have been on the forefront, but it was still an issue back here. These are the biggest issues I've seen with China. Now, population growth. People are saying, well, they just started losing population. Yeah, but this is a country whose GDP per capita is skyrocketing. Even with population decline, if they're not able to reverse that, the amount of growth that China has, GDP per capita, is way ahead of the US. And Alibaba, being a company that sells to the middle class, is in a market of the fastest growing middle class in the world. How is that a bad thing? Let's go check out the 8 pillars on this company. 2 X's, net income growth, ROIC. But one thing I'd say is the net income growth has not matched the cash flow growth. In fact, in the last 5 years, average free cash flow was $23.5 billion, yet average net income was only $15 billion. Way higher free cash flow. I trust this number way more. And guys, when I hear people saying that Baba might be lying about these numbers, that was a concern of mine years ago. But when I see them reporting higher free cash flow than net income, this is the number 99% of investors look at. If they even look at this number, this is their true number, the cash coming into the business. And they started buying back shares. If they're defrauding everybody, which they could be, I will be open to that. Then why are they buying back shares? Is it to perpetuate the fraud of the stock keeping going lower? Maybe. Let's go see what analysts think about this company. And remember, I don't take much for analysts, but it's a way of gauging. Now, analysts are not seeing much growth in EPS. They're seeing growth up until 2027 and then dropping off in 2029. I have no idea why. But as you see the number of analysts decreasing here as time goes on, and revenue, ironically, just continues to grow, 132 billion to 181. Mid-high single digits, nothing to write home about. But remember this, guys, you can still make a lot of money on a slow growth company. Let me show you guys the stock analyzer tool. As you know, if you watch this channel, the stock analyzer tool is a way to sit there and say, okay, I have these assumptions about the future, but what does that mean for what I need to pay for the company today? This does that for you, excluding the balance sheet. You can do up to 20 years of analysis. I always choose 10. First line right here, revenue growth. Guys, I did 3, 6, and 9%. To me, this is very low for a company like Alibaba. This is a company in China that has a fast-growing middle class. A recession in China is 4 or 5% real GDP growth. So I got to think this company is going to grow faster. But let's be conservative at 3, 6, and 9%. Profit margin, I did 12, 15, and 18. Free cash flow, I did 15, 18, and 21. What I should do is make these equal, because eventually the net income and free cash flow will pretty much equate out, okay? PE, I did 16, 18, and 20. And finally, for my desired return, I did 9%. Guys, if you have the software, don't do 9%. This is 9 or 10% should be the market return. If you're buying an individual company, you need to have a higher desired return that gives you your margin of safety. If you're not going to try to get 12, 13% or more, then just buy a low-cost ETF. Don't bother with the hassle of it. But you're going to see how interesting this Alibaba play is. Hit the analyze button. Guys, I have a low price of 104 to 130, high price of 285 to 330, middle price of 170 to 200. The potential is huge here. Doesn't mean it's going to work. But when you're investing in a company, you should ask the question of, if I had 30 opportunities like this, would I do well? And the answer I think on Alibaba is, yes, I will probably do well. So I'm willing to make a bet on that one. Stock number 2, Sprouts Farmers Market. It ranks as my second largest holding, making up 2.9% of my portfolio. But guys, the reason being is my cost basis is a mere $35 a share. I actually think it's a little bit lower than that, but it has skyrocketed in value. It is over 4 times larger. So it started out as a much smaller piece of my portfolio. Now, you might sit there and say, damn, that's awesome. Guess what? It's not awesome. I wanted to buy a lot of shares. I didn't get a full position on Sprouts. I wanted to have 1 to 1.5% of my portfolio in Sprouts as my initial buy-in, not growing into that. So why was Sprouts attractive to me? Well, year to date, it's up 209%, which is not anything I care about. After the company's October 31st earnings report, investment heavyweights like Bank of America, BMO Capital, and Evercore raised their price targets by an average of 20%, signaling immense confidence in the grocer's momentum. Now remember, when these companies increase price targets, guess what I do? I yawn. I don't care. These guys are based on momentum and based on all these other things that don't matter. What I care is about the fundamentals of the business. But Sprouts is now a top 5 holding in the Russell 2000 index, reflecting its growing appeal amongst institutional investors. And when institutional investors get in, it can drive up the stock price. But what do I care about? I care about the fundamentals, and here they are. They posted 8.4% same-store sales growth in the most recent quarter. That is massive. That was also in addition to 38% gross margin and nearly 5% net income margins. So 38% gross margin, 5% net margin. Compare that to a company like Kroger. I believe Kroger is in the 20 to 22% gross margin and in the 1.5 to 2% net margin. Way higher. And guys, this is only getting better for Sprouts, and here's why. They're expanding intelligently. They operate 421 stores with the goal of getting to over 1,200 across only 23 states. And they're building new locations that are actually 23% smaller to maximize efficiency. That's going to help drive up gross margins and therefore bottom line margins. The next wave of openings include states like Virginia, California, Texas, and Delaware, with Wyoming becoming the 24th state in its portfolio. Now, with the mix of financial performance, the strategic growth, and market recognition, Sprouts is planting itself firmly as a leader in the natural and organic retail space. But not only that, the percentage of their sales coming from Sprouts branded products is increasing every single year. And the Sprouts products, instead of a 38% margin, have between 50 and 60% gross margin. As they drive their sales up in this area, I could see this company potentially having 7 to 8% bottom line net margins at some point. It's got to get into that. but they've already increased their net margins to about 5%, which is incredible. Look at the stock. It is absolutely crushed. Now, old Paul would have sold this thing by now, saying, okay, it's gone up too fast, too far. I've learned my lessons. Stick with great companies and hold on to them. There's going to be ups and downs, but my job is to hold on to them. They spend an average of $3.8 million to open a new store, and their profitability their cash on cash returns are in excess of 30% per year once stabilized. Guys, these are huge numbers. I cannot tell you how massive those numbers are. This is a company that can grow 3 times its size, just a number of locations, and increase their profit from today's levels 50% or more on profit margin. Guys, this is the makings of a multi-bagger. And this company, I think, is going to be around for a long time. Now, one thing I will say, they could get acquired. But I'm going to tell you right now, that 150, that's a high price. And we'll show you that here shortly. But let's go look at these 8 pillars right here. Guess what? All check marks except for 5-year PE, 5-year price of free cash flow. It looks expensive, but a lot of growth potential. The question is this a reasonable price to pay for the company? Is that reasonable? 45 times 5-year free cash flow. Now, look at their 5-year free cash flow. Last year was $400 million, 5-year average is $340. So not like it's insanely higher. It's not like it's like NVIDIA where they have $15 billion this year and the last 5 years is like $3 billion. I don't know what the exact numbers are, but we don't see massive growth here. So what kind of premium do you pay for Sprouts? Well, let's see what the analysts think for their growth potential. Look at this, guys. They have Sprouts falling. 373 down to 347 per share in the next 4 or 5 years. Are they right? I don't know. With revenue growing from $7.75 billion to $10.13 billion. Almost a 50% increase in revenue. Again, that seems kind of low if they're going to open stores every single year. So let's go look at the stock analyzer. And let's look up Sprouts Farmers Market and what I put in here. Now, guys, 10-year analysis. 6, 8, and 10% revenue growth. I did profit margin of 4, 4.5, and 5. Same with free cash flow. Probably being a little conservative, but I'd rather make it based on my original assumptions right here. PE, 16, 19, 22. Same with price of free cash flow. And my 9%, no margin of safety, desired return. Analyze button. A low price of about 60, high price of 123, middle price of 85. So in my estimation, I think it's overvalued, but I'm letting my winners run. I have stuck behind Sprouts and I'm going to let them keep going. Now, if Sprouts all of a sudden went to 250 or 275 with these valuations still in place, I might consider selling it going, listen, I don't know. It just seems a little frothy. Can I put the money to better use? That'll be determined later. It's one of the hardest things to do in investing is when to sell your position. Target weighs in as my 3rd largest stock position, making up 2.3% of my total portfolio. Guys, I started buying Target at $135 per share, all the way down to $105 a share was my last purchase. As you can see down here, it was back in October, late last year is when I started. It got as low as $100 per share, 99.66. Guys, I believe in Target. Back here, they were having issues with theft and same-store sales decline. I'm sitting there saying, do I see a world in which Target goes away? That is what makes investing hard. We get comments all the time like, why would I buy a stock when it's going down? Because if it's fundamentally a good business and the fundamentals are getting better or you see an end to the short-term crisis, that's when you buy a company that's falling. You see this? You see this? Does it make it a better investment here than here? That makes no sense. Guys, the stock price is merely the market saying, here's how much we like the company and that's it. That's it. It's actually reflecting the fundamentals of the business. And by the way, I could be wrong on Target. I have no idea. But if I have 30 Target options, 30 options like Target to buy, where I was buying them in the low 100s, I would do that all day long. Target is a retail powerhouse. They have over 1,900 stores. They occupy 246 million square feet of space, making it the 6th largest retailer in the US by revenue, 3rd largest by volume, trailing only Walmart and Amazon. Walmart dominates grocery sales, accounting for 60% of their visits. Target captures a different demographic. Only 22% of Target's customers come in for groceries, with most shopping for discretionary items like apparel, home furnishings, decor, and appliances. Now, despite recent price fluctuations after earnings, Target's core business, I believe, remains strong. The company reported impressive growth figures, including a 10.8% increase in online sales, 2.4% growth in foot traffic, which is about 10 million incremental transactions, and a modest 0.3% rise in overall comparable sales. That 0.3% rise is not a lot. But for a company like Target, it can matter when their same-store sales were declining 3 and 4% recently. In addition, their rewards program, Target Circle, grew by 3 million members, further enhancing customer loyalty. On the digital front, Target's Cartwheel app is a huge success, with 27 million users collectively saving $600 million through these exclusive discounts they offer. This innovative app not only enhances the shopping experience, but also drives significant savings for the consumer, adding another layer of customer engagement to Target's overall business strategy. I do not think Target's going away. I think they're doing a great job of making their experience better for the people who love them, and that's really important. They are a $60 billion enterprise, $103 billion with enterprise value, which includes their leases and things like that. 14% return on invested capital over the last 5 years. Free cash flow, great. People love this dividend. 4.2%, eats up almost half of their last year's free cash flow. Not great, not awful. It's a lot, but that's Target's way of giving back. You know what I prefer? When you're selling for 11 times free cash flow and 14 times PE, get rid of the stupid dividend and buy back 4% of the company every year. But unfortunately, this is why dividends suck. Because if they cut that tomorrow, the stock would plummet. They have no incentive to cut that dividend, even though dividends are absolutely tax inefficient. 8 pillars. Boom. 8-pillar thriller. Buying back shares, which is great. Even with their long-term liabilities, they're still selling for a reasonable price of long-term liabilities of 5-year free cash flow, 13 times free cash flow, 14 times earnings. Guys, everything's a positive here. 5-year cash flow growth is greater than their 5-year net income growth. I like it. I like it a lot. Let's see what analysts think about Target. Well, they're much more optimistic on Target. $8.42 per share here, going to $13. And revenue growth of about inflation, 3-4% a year. You're not going to get much growth from that. Yeah, you might get a little bit more because they're opening more stores, but I really want to make sure you guys see that it's all about looking at these companies from a long-term perspective. All these companies, most of the companies I own, I sit there and say, do I see a world in which this company is going to be around for decades? If the answer is yes, do I think they're going to make more revenue and profit in the future than they do today? The answer to that is yes. The third question is, can I pay a reasonable price today that gives me an adequate return on my capital, factoring in that future growth potential? If the answer to all that is yes, my question is, why am I not buying? And I sit that and see that with Target at the prices I've purchased it at. With my basis around 115 to 120, I feel like I have a very good potential for a very good stock. But of course, you must use the stock analyzer tool to see that for yourself. Putting in your own numbers. You might disagree with me on my assumptions here. On a lot of these companies, that's fine. There's a reason why the stock analyzer tool is used over 1 million times every single year by our users. They love to put their own numbers in. They should. Your return requirements are going to be different than mine. Your PE and price of free cash flow are going to be different than mine. Your assumptions are probably going to be different than mine. We might end up getting the same number, but through a different path. That's why this tool is so important. It allows you to put numbers to the story that you're attaching, and that's what good investing is. So here are the numbers I assume for Target. 2, 3.5, 5% revenue growth. Profit margin, 375, 425, 475. Same with free cash flow. Even though their free cash flow tends to be higher than their profit margin. Look at that. Higher in the last 10, 5, and last 1 year. PE, 15, 18, and 21. I could argue it should be higher than that. And a desired return of 9%. Now, guys, if you've been to our website, you may have noticed that there's a wait list going on. The reason being is our software right now includes all of our tools for retirement, stocks, and even real estate. But behind the scenes, we're making changes. As our needs change as an investment company, and as we see what people need to make better decisions, we are going to be making the software better and better. Originally, this software was built just for myself and just basically the stock analyzer tool. But as we made videos from the very beginning, Most common question we got was, how do I get that software? How do I get that Excel sheet? And at the time I was like, listen, this is an expensive data feed. You can't just go get it. So it gave us the idea. Let's go create this for people. And along the way, we created the community of like-minded investors, thousands of them. As we've grown, it's becoming less about me and more about how I can serve you, the viewer, as well as our community member, the thousands of people in there, much better. And this is why we update our software to give you exactly what you need as time goes on. And the good news is all of these changes are going to take time. So if you join today, you'll be grandfathered in for life with everything here before we split it all off. And it's the best deal we're ever going to offer. I'm telling you this now because there's still time for you to sign up. As long as you join Everything Money and the community today, before we make these changes, you can keep your plan even after these changes are made. And most importantly, you'll stay in your pricing tier forever. So click on the link in the description below to get everything we have to offer, including all of our investing tools and the community here with the access to like-minded investors. It's in all likelihood going to be the best decision you'll make in your life because it'll help you make better decisions along the way. Instead of sitting there and saying, oh, I like Target at 1, you'll know exactly what price you want Target at. So to finish up Target, hit the Analyze button. I have a low price of 125, high price of 243, middle price of 175. And guys, these returns here include that massive dividend. So even at this price today, it's looking pretty attractive based on my assumptions. But again, don't go based on mine. You must do your own analysis. PayPal is my fourth largest stock holding, consisting of 1.9% of my portfolio. I started buying at 85 all the way down to the low 50s, and now it's at $85 per share. So even my original purchase, I'm almost even on, if not even. Now, being even up, down, that doesn't affect me in the short run. What affects me in the short run is, what are the fundamentals doing? PayPal is a company that was at an all-time high of 310 a mere 3 years ago and plummeted from there. And the story is about PayPal being dead. Guys, PayPal isn't just a leader in digital payments. It's the number one payment processor in the world, commanding 45% of global payments market. Venmo, its peer-to-peer app, has over 90 million active users, with 26% of them being young adults aged 18 to 29, fueling the surge in mobile payments. Add to that, 85% of PayPal users base being millennials, and it's clear that PayPal has a young, engaged audience. Plus, its buy now, pay later service has absolutely exploded, growing by a staggering 867%, showing the company's knack for tapping into trending consumer demand. Now, the negative story on PayPal was they have a short-term loss overall of active users, but that's not the full story. The better story is the number of transactions per user is up, and the cost and the revenue per user is a lot higher. And that's what matters here. So a company like this generated $8.15 billion in free cash from the last year, relative to $5.45 billion in net income, and $6.57 billion average free cash flow, compared to $3.76 billion in net income. So the play here is the free cash flow. That is what matters here. Now, look at this. Overall gross margin, 45%. Bottom line, about 15%. And again, that's net income gross margin, not free cash flow. So they have huge numbers growing here. For a company that's dying, that's a lot of free cash flow to have in the last year. In the last 12 months, this dead company has generated $7 billion in free cash flow compared to 4.2 last year, 5.1 the year before, 4.9, 5.3, 3.3, 4.7, 1.7. You get the point. Now, does this mean it's a permanent plateau? I don't know. But the stock price and the story are not the same. They're not matching up. I think there's a mispricing here for the company. So let's go see what the analysts think about this company. Look at this. They have the company going from 466 earnings per share to 691. So much for dead. Revenue-wise, $32.3 billion to $45 billion in the next 4 or 5 years. Again, so much for dead. Not massive growth, but I look at this going, okay, well, that's interesting to me. So let's pull up the stock analyzer tool and see what my assumptions were in the past. I did 4, 7, and 10% revenue growth. Profit margin here, 12.5, 14.5, 16.5. My free cash flow was a lot greater, 16, 20, and 24. I did 14, 17, and 20 on my earnings and free cash flow multiple. Keep in mind, guys, It's selling for like 10 times free cash flow right now. Pretty cheap. And my 9% desired return, stock's currently at 85. I have a low price of 60 to 80, high price of 160 to 230, middle price of 100 to 140. I think there's a lot of upside here. Look at that low price right there. Just buying today and the low assumptions occurring can look at a 7.8% free cash flow return. My fifth largest holding is HPQ. It makes up 1.77% of my portfolio with a cost basis where I started buying around $33 per share and lower. And as you can tell, I've had the stock for a while. And as you can tell, it's been in a pretty tight range for quite some time, hitting a low earlier this year of $27 per share, $27.43. HP is on track to generate around 3.1 and 3.6 billion in free cash flow for 2024. Now, the reason that's impressive, their market cap is 3.6 billion. It's still at under around 10 times free cash flow, with plans to return nearly 100% of that cash flow to shareholders through dividends and share repurchases. Hey, guess what? Stop giving this dividend away. 3.65%, get rid of it. This 1.33 billion in dividends, buy back your shares. $4 billion in free cash flow last year, they could have been using that to buy back 11% of the company every single year. This reflects the company's strong financial health and commitment to delivering value to its investors. Additionally, HP's future-ready plan is targeting $1.6 billion in gross structural cost savings by the end of fiscal 2025, a move that will improve margins and increase available capital for reinvestment into key growth areas. On top of this, HP is making significant strides in the digital space, particularly through AI-driven solutions and subscription-based services like the HP All-In Plan. Now, let's go take a look at their 8 pillars here. Now, a little bit choppy. You've got declining net income, declining cash flow, declining revenue. This is a declining business from all metrics looking at it. And the reason, though, that I look at this is like, well, it's selling for a cheap price. They're paying a dividend out, and they're buying back a ton of shares. If they can just buy back $1 billion or $2 billion in shares every single year and figure out a way to stay stable and increase those margins with the cost savings, this company could just be a company that stays stagnant yet the stock price goes up. Look at this return on invested capital. 132% a year for the last 5 years, 62% in the last year. Now, obviously, they can't redeploy that money at those returns, but it shows that their basis in the company is decreasing and they're buying back shares and making it so much better for the investor. Now, let's see what analysts think about the company. Ironically, there's still growth here according to analysts. $340 a share, growing to $440 per share in the next 4 or 5 years on earnings, and revenue about the same, $54 billion to $56.7 billion. Not much growth. That's okay, because I'm going to show you in our stock analyzer tool how this can absolutely actually help still the company do well. Guys, look at these assumptions I made. -3, 0, and 3% revenue growth. Profit margin, 5, 6.25, 7.5. And even though their free cash flow is significantly higher than their profit margin, I made their free cash flow the lower profit margin number. PE, 10, 13, 16, 9% desired return. I hit the analyze button. Guys, I got a low price here of 22 to 24, high price of 64, middle price of about 40. So buying it for low 30s and below 30, I'm pretty happy with. Now, guys, if you want to see the full 33 stocks that I want to own, watch our next video. Thank you for your time.